Is it important for any business to know how much and what type of item they have available for sales? In this video, we'll learn what inventory is and how to count it, and why is it so important. How do we define inventory? Can you count? If your answer is yes, then guess what? You have already mastered the biggest part of taking a physical inventory count. The first things that I need to do is to explain to you exactly what I'm talking about when I use the term of inventory. Well, inventory is the items on hand that are considered assets to a business and are used to bring in income. Why taking inventory? Taking inventory really is a time-consuming job. So, why do it? Is this really that important? Yes, most definitely is yes. Inventory is an asset. An asset is something that a company owns that has value and can be used to create revenue. Yeah? So if the amount of inventory that the company has is incorrect, then the total amount of assets that the company has will also be incorrect. Yeah? So as it will be the total of amount of incomes that a company reports on their financial statement. Inventory that's overstated, meaning that the amount of inventory reported is more than what is actually on hand, result in net income being overstated. Yeah, net income is the amount of money that a company makes in a given time period after all expenses have been deducted. If net income is overstated, then it looks like the company made more money than it's actually did. On the other hand, if your inventory is understated, meaning that the amount of inventory that is reported is less than what is actually on hand, then the net income is also understated. This means that it looks like the company made less money than it should actually did. In order to ensure accuracy in inventory, a physical count of the inventory must be taken. How to take inventory planning is the number one key to success when it comes to taking inventory. But what exactly do you plan for? The number one the things to do when preparing for an inventory count is to make sure to preview your inventory or to look over reports of what is supposed to be in your inventory. Most companies have an automated inventory control system that allows the user to see what's the quantity, the end balance they have in their computer system. Even if a company doesn't have an automated inventory system, some of them they are using manual recording of what is supposed to be in their inventory book, right? After reviewing what should be in inventory, management should make sure that grouping occurs, right? Groupings means that all categories of items are grouped together in their appropriate locations, so that is easy to group together what inventory to be carried out for inventory counting process. For example, in a clothing store, all short sleeve shirts should be grouped together by maker, sizes, and colors, right? So doing this before the actual process of inventory counting helps to ensure that everything is counted as accurately as possible. Once this step is done, it is time to create the counting team and the counting list. Counting team is those individuals who will be counting a specific item, while counting lists are the items that will be counted. Knowing who is counting what allows management to track the accountability of the numbers, right? So, in order to keep the counters from performing redundant counts on the same item, it also allows members of the counting team to know what they are supposed to count. Another important step in the inventory counting process is to be sure to hold data entry. This means that all transactions involving inventory are held during the inventory process. What do I mean by that? Well, if you are going to count inventory on a specific day, and that count is compared to what is believed to be in inventory on that day, right? Then there does not need to be any inventory adjustment made. Inventory adjustment are additions or subtractions to inventory. By this point, the planning stage is complete and the actual physical count of inventory can commence, right? Misstating inventory. So how exactly does this misstating inventory cause net income to be wrong? In order to calculate net income, there are several variables that we need to consider. The basic formula states that net income equal to sales minus cost of goods sold minus your operating expenses plus other revenue minus other expenses, right? So the components of the formulas that we are going to focus on for this lesson is the cost of goods sold. So it is the dollar amount that items sold during a specific time period to generate revenue cost to the company. So this amount could be calculated by using the total cost of each specific item sold. But that will be a time-consuming project. Instead, the amount is figured out by adding the total cost of new purchases to the report value of beginning inventory and subtracting the ending inventory value reported at the end of the period. If the inventory value reported is wrong, then the cost of goods sold value will be wrong. So what's the lesson summary here? Which will make the net income wrong? Inventory is the item on the hand that are considered asset to a business and are used to bring income. There are 5 basic steps in the planning process. Yeah. First is preview your inventory, means to look over reports of what is supposed to be in your inventory, right? Your inventory transactions could receive stock in, stock out. Second is a grouping of inventory, means that all categories of items are grouped together in their appropriate locations. Third is the counting team. Those are the people or your employee who will be counting your specific item. Fourth is the holding data entry, means that all transactions involving inventory are held during the inventory process. Inventory adjustment, which are the additions or subtractions to your inventory to ensure that inventory on the counting list are as accurate as possible, right? So overstated inventory means that the amount of inventory reported is more than what is actually on hand, as well as understated inventory meaning that the amount of inventory reported is less than what is actually stated on hand. Both have effects on the net income of a business, right? So during my consultations with the user, what we normally practice for our inventory counting SOP is, first, I will get them to print a physical list, right? This physical list is sorted by the group of items in the list. Second, give the list to the team for counting the items. Third is the team will fill out the spreadsheet and enter the physical count quantity to the on paper or to the device. Fourth, the team will return the spreadsheets or the count tag to the manager, right? And the manager will check the acceptance quantity, right? If the variance is within the tolerance level, it will be accepted and updated to their inventory system. Well, if it is not accepted, second count may be required, right? So if the variances is too high, the managements may have to look into the root cause of their inventory problem, right? Fifth is the manager enter the data into the inventory system. So with the appropriate reason for the variances, it could be the reason for the write-off, the wastage, the breakage, the scrap. Then only your proper inventory counting process will be considered complete, right? So, are you having any challenges with your inventory counting process? Do share with me. As always, if you learn something new in my video, please give me a thumbs up and subscribe to my channel with notifications. My name is Vivienne and I shall see you in my next video.